Hey traders, Todd Gordon here with tradinganalysis.com. This is CNBC Trading Nation. Traders, we're going to go to work on Tesla. Tesla's looking very good heading into earnings on February 7th. I like the technical position and I like the implied volatility of these options heading into earnings. So first, let me set up the technical picture for you. I'm a big follower of the Elliott wave theory. This is a market. This is a methodology within technical analysis that helps you figure out and get context in terms of how progressed you are in a respective market trend or correction. And at the heart of the model is the idea that there are 5 waves in a good complete market phase. So 3 of them will be trends, 2 of them will be corrections. And the way I see this on Tesla is here's your first wave. This is your first uptrend. First corrective sequence there in wave 2. Next market uptrend, that's going to be labeled as wave 3. We just saw a pretty good consolidation here in most of 2017. That's going to be your wave 4. And the final and 5th wave that you'd expect here is going to be wave 5 that takes us up towards that $500 mark. So heading into 2018 into 19, I'm bullish on this stock for a move up. Now, we have earnings on February 7th. Let's take a look at the level of implied volatility heading into earnings. And what you're going to see is pretty much the case throughout. Heading into earnings, you're going to see a spike up in this green line for earnings, which is labeled here in your charts with E. So you got a spike in implied volatility, and notice what happens right after earnings. Regardless of what the stock does, volatility drops. Same thing here. Earnings right there. Earnings, I'll just label a couple for you here, and then we're going to notice what happens right after the implied volatility. Right after the earnings, look what happens. Bam, implied volatility comes out. Bam, implied volatility comes out. Bam, implied volatility comes out. Regardless of what happens to the underlying stock, whether it goes down, whether it goes sideways, whether it goes up, whatever. Okay, so the same thing is happening now for earnings next week. Implied volatility right up against the upper resistance level. That tells you that the level of options, the expected movement around these earnings are very high. You can use that to your advantage. We have a directional bias based on the wave principle, which says we should have a wave 5 move up. We have very expensive options heading into earnings, so we could combine those two into a good option strategy, which would be not to buy expensive calls to be bullish, but to sell expensive puts to be bullish. So the trade I'm looking to do here is in the options that expire February 9th. Okay, we have earnings on the 7th, so these are very close to expiration. The reason we do that are the options that cover earnings are very expensive, and then the options that expire in the weeks after, those don't have such a volatility premium into them. So we're going to go ahead and we are going to sell a put that's just below the market. We're trading at 352 right now. Let's go ahead and sell the 350 put. We're going to buy the 345 put. The net credit to your account, this is a credit spread, will be $2.23 in your pocket right now. That is max profit on the trade. Max loss is our $5 spread minus the 223, which comes out to about, well, it just changed on us, down to 277. It's going to fluctuate with the bid and ask of the options. So we have about 277 at risk to make 223. Why would you take a skewed reward to risk ratio like that? Well, as the risk graph shows you, you're not going to lose money over here at the zero line. You don't cross below zero until we get below $347.95 roughly. So that's about $5 lower than the current price. You don't lose money in this trade until we drop another $5. And plus, when that volatility comes out, the put spread that we're initiating, that's going to pick up value because the puts that we're short will drop very quickly, faster than the puts that were long. That's that implied volatility IV crush post earnings. Okay, there's a lot of things at work there, but basically you're expressing your bullish bias, selling expensive puts, heading into earnings. We can do this for about 223. That trade is now working. 223. I'm going to let that trade work. Now, there won't be a stop loss on this. I position size such that if the trade goes completely wrong, that's fine. I'm heading into earnings, which are released after hours, so there's nothing we can do in terms of a stop loss. We're in, okay? So position size appropriately. Guys, that is the trade in Tesla. For CNBC's Trading Nation, I'm Todd Gordon. Good luck on that. Be sure to follow us at Trading Nation for updates to all the trades and markets that our traders are watching, and we'll see you guys in the next video update.
Hey there, thanks for checking out CNBC on YouTube. Be sure to subscribe to stay up to date on all of the day's biggest stories. You can also click on any of the videos around me to watch the latest from CNBC. Thanks for watching.